70 and a half is not a dead age in the tax code. Most retirees treat it like an old rule that stopped mattering. They think the real retirement ages are obvious. 59 and a half, when the early withdrawal penalty usually disappears. 62, when Social Security becomes available. 65, when Medicare begins. 73, when required minimum distributions may start for many retirees. Those ages get all the attention, but 70 and a half gets skipped. And that is where a lot of retirees make an expensive mistake. Because at 70 and a half, certain IRA moves become available that can change how money shows up on your tax return. Not how much money you have, not how much money you spend, how the IRS sees it, and that difference can matter. One move can raise your adjusted gross income. Another move can move the same money without raising it the same way. One withdrawal can push more of your Social Security into the taxable zone. Another route may help keep that income number lower. One decision can increase the income number Medicare looks at later. Another decision may avoid creating that extra pressure. That is why this age matters. Not because every retiree should do the same thing. Not because there is one magic strategy, but because after 70 and a half, the question changes. You are no longer only asking, how much should I withdraw? You should also be asking, what happens to my tax return if I move the money this way? That is the part most retirees miss. They focus on the account balance. The IRS focuses on the income number. They focus on the check they need. The tax system focuses on how that check is reported. And by the time they find out, the year is already closed. The form is already issued. The income is already on the return. And the mistake is no longer a planning decision. It is a tax bill. In this video, I'm going to walk through 7 IRS rules and retirement moves that become important after 70 and a half. Some can help with charitable giving. Some can affect future required withdrawals. Some can change how much of your Social Security gets taxed. Some can help you avoid creating a Medicare premium surprise later. And one simple paperwork issue can cause retirees to pay tax they may not have owed. This is not tax, legal, investment, or financial advice. This is education. Your result depends on your filing status, your IRA balance, your Social Security, your other income, your state, and your full tax return. But do not ignore 70 and a half, because the IRS does not call you when a better route exists. It does not warn you before a normal withdrawal creates a bigger tax problem. And it does not refund money just because you did not know the rule was available. Before we go further, understand this clearly. I am not your CPA. I'm not your attorney. I'm not your financial advisor. This video is for education only. It is not tax advice, legal advice, investment advice, or a recommendation to move money without checking your full situation first. Your result depends on your filing status, your income sources, your state, and sometimes even one corrected form that arrives after the year closes. So before you use any strategy in this video, speak with a qualified tax professional who can look at your actual return. Now, if you are new here, this channel is built for retirees and pre-retirees who want retirement rules explained in plain English, not vague headlines, not financial industry language, not talk to your advisor, and nothing else. Real examples, real tax triggers, real mistakes that can show up years after the decision was made. If that is what you came here for, hit subscribe. Because the next video goes into the moves most retirees miss before required withdrawals begin. And before we get into number 1, answer this in the comments. Are you already over 70 and a half? Just type yes or no. That one answer tells me whether the next breakdown should focus on people already using these rules or people getting ready for them. Now let's start with the one that affects the most retirees, and the one that gets misused the most. Number 1 is the qualified charitable distribution. This is the move that makes age 70 and a half matter immediately. Not 73, not 75, 70 and a half. A qualified charitable distribution, or QCD, lets you move money directly from a traditional IRA to a qualified charity. The key word is directly. The money does not go to your checking account first. It does not pass through your hands. It goes from the IRA custodian to the charity. And that route is what changes the tax result, because when it is done correctly, the distribution can be excluded from taxable income. That means it may not raise your adjusted gross income the same way a normal IRA withdrawal would. And that matters more than most retirees realize. A normal IRA withdrawal can affect more than one line on your return. It can increase taxable income. It can raise provisional income. It can cause more of your Social Security to become taxable. And if the number crosses certain thresholds, it can trigger Medicare premium surcharges later. But a QCD works differently. You are still supporting the charity. You are still moving money out of the IRA. But instead of taking the withdrawal personally and then writing a check from your bank account, the money travels straight from the IRA to the charity. Same charitable gift, different route, different tax result. One important note. This is normally a traditional IRA strategy because Roth withdrawals are already tax-free in many cases and do not create the same tax benefit. And the check should be made payable to the charity directly, not to you. If the custodian sends the money to you first and then you write the check, you may have just turned a QCD into a regular IRA withdrawal. That is the mistake. The money has to move the right way. That is why this rule is so powerful for retirees who already give to a church, a nonprofit, a food bank, a school, a hospital, or another qualified charity. If you are already giving that money anyway, the question is not only how generous you are, the question is where the money should come from. Because writing a check from your bank account may feel simple. But if you are over 70 and a half and you have traditional IRA money, that simple habit may be costing you. For 2026, the QCD limit is extremely high for most ordinary retirees. Up to $111,000 per person can be treated under the annual QCD limit. A married couple can each use their own IRA if both spouses qualify. Most retirees will never come close to that limit, but they do not need to. Even a smaller gift can matter if it keeps income off the return. $500, $2,000, $10,000. The number is not the only thing that matters. The root matters. And once required minimum distributions begin, a QCD can also count towards satisfying all or part of that required amount. That means later, when the IRS forces money out of the IRA, you may be able to send some of that required amount directly to charity instead of taking it as taxable income first. That is the part many retirees miss. They think charitable giving is only about deductions, but after 70 and a half, it can also be about income control. And in retirement, controlling income can be just as important as claiming deductions, because the IRS does not only look at what you gave, it looks at what showed up as income first. Now let me show you why the root can change the actual tax bill. Now watch how this works in a real retirement situation. A retired couple gives money every year to their church and 2 local charities. Nothing huge. They give $7,000 for the year. For years, they have been doing it the normal way. Money comes out of their bank account. They write the checks. They feel good about the gift. But their IRA money is still sitting there. Then later, they take IRA withdrawals for living expenses. Those withdrawals show up as income. That income raises the number on the return. And that number can affect more than just regular tax. It can affect Social Security taxation. It can affect Medicare income calculations later. It can affect whether a small retirement decision becomes a bigger tax surprise. Now change only one thing. Instead of writing $7,000 from the checking account, they ask the IRA custodian to send $7,000 directly from the traditional IRA to the charity as a QCD. Same charities. Same total gift. Same lifestyle. But now that $7,000 may stay out of taxable income, their adjusted gross income can be lower, their provisional income can be lower, and depending on the rest of the return, less of their Social Security may be pulled into the taxable calculation. Even keeping $7,000 off the return can sometimes save a retiree more than the tax on that amount alone, because of how it affects Social Security and Medicare calculations. That is the power of the route, not the amount. The root. Most retirees are not losing money because they are ungenerous. They are losing money because they are giving from the wrong pocket. But there are mistakes that can destroy the benefit. Mistake number 1, the money is deposited into your account first. If the IRA sends the distribution to your bank account and then you donate it, that is not the same thing. Mistake number 2, the check is made payable to you. Even if you plan to hand that check to the charity, the problem is still the same. The money touched your hands first. Whether it was a direct deposit or a check made out to you, the result can change. The charity still gets the money, but the tax treatment may not be the QCD treatment you expected. For a clean QCD, the payment should be made payable to the charity. Mistake number 3, you try to use a donor-advised fund. Many retirees assume every charitable account qualifies. It does not. A QCD generally has to go to a qualified operating charity, not a donor-advised fund. Mistake number 4, you do it before you're actually 70 and a half. Not the year you turn 70? Not close enough? 70 and a half on the date of the distribution? That date matters. If your birthday is in October, you do not reach 70 and a half until April of the following year. Do not assume the calendar year is enough. So, if you give to charity and you're over 70 and a half, do not just ask, how much should I give? Ask this instead, should this gift come directly from my IRA? That one question can change the tax result, and it becomes even more important once required minimum distributions enter the picture. Number 2 is the one-time QCD to a split interest charitable arrangement. This is not the normal QCD most retirees hear about, and that is why almost nobody uses it. Under current rules, a retiree who qualifies for QCDs may be able to make a one-time transfer from an IRA to certain charitable arrangements, such as a charitable gift annuity or certain charitable remainder trusts. For 2026, that one-time limit is $55,000. Not every charity offers this. Not every retiree needs it. And this is not something you set up casually after watching a video, but for the right person, it can matter. Here's the basic idea. Instead of taking IRA money into your own account, paying tax on the withdrawal, and then using what is left to fund a charitable income arrangement, the money may be moved directly from the IRA into the qualifying charitable structure. That can keep the initial transfer from being treated like a normal taxable IRA withdrawal, and the arrangement may then pay income back under its own terms, while the remaining charitable interest eventually benefits the charity. That is why this rule is different. A regular QCD is usually simple. Money goes from the IRA to the charity, done. This one is more advanced. There may be payout rules, there may be age rules, there may be charity-specific documents, there may be tax reporting issues that need to be handled correctly. So do not treat this like a quick form. Treat it like a planning conversation. If you are charitably inclined, have a large traditional IRA, and want part of your charitable giving connected to lifetime income, this is the question to ask your tax professional. Does the one-time QCD option to a charitable gift annuity or remainder trust make sense for me? Most retirees will never need it, but the retirees who do need it often never hear about it. Number 3 is the window before required minimum distributions begin. This is where many retirees get the calendar wrong. They hear 70 and a half and think it no longer matters because RMDs do not start at 70 and a half anymore. That is only half true. RMDs may start later, but QCDs can still begin at 70 and a half. That creates a planning window. For some retirees, that window may last a few years. And those years can matter, because once required minimum distributions begin, the IRS starts forcing money out of traditional retirement accounts every year. That forced withdrawal is based partly on the account balance from the prior year. The larger the IRA balance, the larger the required withdrawal may be. The larger the required withdrawal, the more income may show up on the tax return. And once that income shows up, it can affect more than regular income tax. It can affect how much of Social Security becomes taxable. It can affect Medicare income calculations. It can affect whether a retiree quietly crosses a threshold they never meant to cross. This is why the years between 70 and a half and RMD age are not empty years. They are control years. If you already give to charity, a QCD during this window may do two things at once. It may keep that charitable transfer out of taxable income, and it may reduce the IRA balance before future RMDs are calculated. That does not mean every retiree should drain an IRA through charitable gifts. That is not the point. The point is that if the giving was already going to happen, the IRA may be the better source. Let's say a retiree gives $10,000 a year to charity from a checking account. At the same time, a large traditional IRA keeps growing. Then RMDs begin. Now the retiree is forced to take income from the IRA, even if they do not need all of it for spending. But if that same retiree had routed those charitable gifts from the IRA during the pre-RMD window, the future balance may be lower, the future required withdrawal may be lower, and the future tax pressure may be lower. That is the part most people miss. They wait until RMDs begin. Then they start asking how to reduce the tax hit. But by then, the account balance has already grown. The first RMD has already been calculated, and the window where they had the most control is partly gone. So if you are over 70 and a half but not yet taking RMDs, do not treat those years as a waiting room. Treat them as a planning window. Because once RMDs start, the IRS calendar gets louder, and your options may become more crowded. Number 4 is the Roth conversion window before required withdrawals begin. This one is not about charity. It is about control. Because once required minimum distributions begin, your tax return starts with income you may not have chosen to take. That changes the Roth conversion math. A Roth conversion means moving money from a traditional IRA into a Roth IRA. The converted amount is usually taxable in the year of the conversion. But after that, qualified Roth withdrawals may be tax-free later. So the question is not simply, do I want to pay tax? The real question is, do I want to pay tax on some of this money now before the IRS forces more income out later? That is why the years after 70 and a half can matter. You may already be past the early retirement years. You may already be collecting Social Security. You may already be on Medicare. But if your required minimum distributions have not started yet, you may still have a window. Not a perfect window, not a risk-free window, but a cleaner window than the one you may have after RMDs begin. Here is why. Once RMDs start, the required distribution generally has to be handled first. You cannot simply convert the RMD itself and pretend the requirement disappeared. That forced income comes onto the return first. Then the Roth conversion stacks on top of it. And that stack can push you into a higher bracket, expose more Social Security to tax, or move your Medicare income number closer to a surcharge threshold. Before RMDs begin, you may have more room to choose the conversion amount. Maybe it is $5,000. Maybe it is $15,000. Maybe it is more. The number is not the point. The point is that you still have some control over how much income you create. Once RMDs begin, part of that control is gone. Let's say a retiree is 71. She has Social Security, a small pension, and interest income. Her taxable income is still low enough that part of the 12% bracket is unused. If she does nothing, her traditional IRA continues growing. Then at RMD age, forced withdrawals begin. Those withdrawals may fill the bracket space she used to have. Now a Roth conversion has to sit on top of the RMD instead of fitting into the open space before it. That is the difference. Same IRA, same retiree, different year, different tax result. This does not mean every retiree should convert aggressively. A Roth conversion can raise current taxes. It can raise MAGI. It can affect Medicare premiums 2 years later. And if you convert too much in 1 year, the cure can become the problem. But ignoring the window can also be expensive. Because every year you wait, the IRA may keep growing. The future RMD may get larger. And the cleanest bracket space may disappear. So if you are over 70 and a half and not yet taking RMDs, ask a very specific question before the year ends. How much could I convert without crossing the next tax bracket, Social Security tax zone, or Medicare RMA threshold? That question is where planning starts, not after the RMD begins, before. Because after required withdrawals start, the IRS does not ask how much income you wanted. It tells you how much income must come out. Number 5 is not a new strategy. It is a paperwork trap. And paperwork traps are where retirees quietly overpay. When you take money from an IRA, the custodian sends a Form 1099-R. That form tells the IRS a distribution happened. The problem is that for years, many QCDs looked almost identical to regular IRA distributions on the form. So the retiree did the right thing. The money went directly from the IRA to the charity received the gift, the retiree thought the tax part was handled. Then tax season came. The software saw the 1099-R. The preparer entered the distribution. And if nobody marked the QCD correctly on the return, the money could end up treated as taxable income. That is how retirees pay tax on money that was supposed to be excluded, not because the strategy failed, because the reporting was handled wrong. Now there's a new code connected to this issue. Code Y on Form 1099-R is used to identify a qualified charitable distribution. That can help reduce confusion. But here's the part you need to understand. Do not rely on the form alone. For 2025 reporting, the IRS said using Code Y is optional. That means some custodians may use it, some may not. So if you did a QCD and you do not see Code Y, do not automatically assume the QCD failed. And if you do see Code Y, do not automatically assume your tax return handled it correctly. You still need to check the return. Look at the 1099-R. Look at the taxable amount. Look at how the QCD was entered. Look at whether the distribution was excluded properly. This is where a 5-minute review can matter. Because one wrong entry can raise your AGI. One wrong entry can affect Social Security taxation. One wrong entry can make Medicare look at a higher income number later. If you made a QCD and later discovered it was reported as taxable income, ask a tax professional whether an amended return makes sense. Do not assume the mistake is too small. In retirement, small reporting errors can create large chain reactions. And if you have made it this far, this is exactly why this channel exists. Not to make taxes sound complicated, to show you where the hidden tripwires are. So hit the like button if this is helping you. Subscribe if you want retirement tax rules explained before they become expensive. Now let's move to number 6, because this is where QCDs connect directly to Social Security. Number 6 is Social Security income management. This is where many retirees misunderstand the problem. They think the question is only, how much Social Security do I receive? But the tax return asks a different question. It asks, what other income did you stack on top of it? That is why age 70 and a half matters. By this point, many retirees are already collecting Social Security. Some delayed until 70, some claimed earlier. Either way, the benefit is now part of the household income picture. And once Social Security is flowing, every IRA withdrawal has to be tested against the Social Security tax formula. The IRS does not look at your income sources separately. It combines them. Your provisional income generally includes half of your Social Security, plus your other income, including tax-exempt interest. That number decides whether part of your Social Security becomes taxable. For a single filer, once that number moves above $25,000, the tax calculation can begin. Above $34,000, up to 85% of Social Security benefits may become taxable. For married couples filing jointly, the key numbers are $32,000 and $44,000. This does not mean Social Security is taxed at 85%. That is a common misunderstanding. It means up to 85% of the benefit can be included in taxable income, and that difference matters. Now watch the chain reaction. A retiree takes a normal $10,000 IRA withdrawal. That withdrawal raises income. That higher income can pull more Social Security into the taxable calculation. So the real tax cost may be more than just the tax on the $10,000. The withdrawal can create a second tax effect. But if that same retiree was already giving $10,000 to charity and the money moved directly from the IRA to the charity as a QCD, the tax result may change. The charity still gets the money, the IRA balance still goes down, but the taxable income number may stay lower. That can help keep provisional income lower, and lower provisional income may protect more Social Security from being taxed. That is why QCDs are not only a charity tool. After 70 and a half, they can become an income control tool. Because in retirement, the most expensive money is not always the money you spend. Sometimes it is the money that shows up on the wrong line of the tax return. Number 7 is the stack. This is where the rules start working together. Most retirees look at each retirement rule separately. Social Security is one thing, IRA withdrawals are another thing, Roth money is another thing, charitable giving is another thing, the senior deduction is another thing, but the tax return does not treat your retirement as separate little boxes. It adds the pieces together, and that is why the stack matters. For tax years 2025 through 2028, many taxpayers age 65 and older may qualify for an additional senior deduction. The maximum amount is $6,000 per eligible person. For a married couple where both spouses qualify, that can be $12,000. But this deduction has income limits. Once modified adjusted gross income gets too high, the benefit can start phasing out. That means the deduction is useful, but it becomes more powerful when you combine it with income control. This is where QCDs and Roth withdrawals can matter. A QCD may help keep traditional IRA charity money from increasing adjusted gross income. A qualified Roth withdrawal may provide spending money without adding taxable income, and the senior deduction may reduce taxable income further. Now watch the difference. One retiree needs $50,000 to live for the year. Social Security covers $30,000. The retiree needs another $20,000. Option 1, take the full $20,000 from a traditional IRA. That withdrawal can raise income. It can affect the Social Security tax calculation. It can move modified adjusted gross income higher. And if the retiree is close to a Medicare threshold, it can create a problem later. Option 2, use a smaller traditional IRA withdrawal, use Roth money for part of the spending need, and route charitable giving through a QCD if the retiree was already giving anyway. Same lifestyle, same bills paid, same retirement year, but a different tax picture. That is the stack. You're not trying to cheat the system. You're using the rules in the order that creates the least damage. Roth money for spending, QCDs for charitable giving, senior deduction for eligible taxpayers, traditional IRA withdrawals, only after you understand what they do to the rest of the return. This does not mean every retiree can pay zero tax. Be careful with that idea. Some retirees have pensions, some have large RMDs, some have capital gains, some have rental income, some live in states with their own rules, but the principle still matters. The more control you have over what counts as income, the more control you may have over the tax chain reaction. That is why the senior deduction by itself is not the whole story. The real power is knowing what income you create before the deduction is even applied, because deductions help after income exists. QCDs and Roth withdrawals can help manage whether certain income shows up in the first place. That is the difference most retirees miss. They ask, what deduction can I claim? But after 70 and a half, a better question may be, what income can I avoid creating unnecessarily? That question can change everything. Now bring all 7 together. After 70 and a half, the tax code gives retirees tools most people never connect. Number 1, the QCD. Money can move directly from a traditional IRA to a qualified charity without creating the same taxable income problem as a normal withdrawal. Number 2, the one-time QCD option for certain charitable income arrangements. Advanced, not for everyone, but important for the right retiree. Number 3, the pre-RMD window. Those years before required withdrawals begin are not dead years. They are planning years. Number 4, the Roth conversion window. Before RMDs start filling your tax return, you may still have room to move money on your terms. Number 5, the 1099-R reporting trap. A good strategy can still create a bad result if the paperwork is handled wrong. Number 6, Social Security income management, because every IRA withdrawal can affect more than just the IRA. And number 7, the stack. QCDs, Roth withdrawals, and the senior deduction can work together when the order is planned correctly. 7 rules, 1 lesson. After 70 and a half, the money is not the only issue. The root is the issue. So here's what I want you to do before this year closes. Not someday, not after the tax return is already filed. Before the next move happens. First, if you give to charity and you're over 70 and a half, call your IRA custodian. Ask them how to send a qualified charitable distribution directly from your traditional IRA to the charity. Do not guess. Do not move the money to your bank account first. Ask for the correct process before the gift is made. Second, calculate your provisional income before taking another IRA withdrawal. Take half of your Social Security. Add your other income. Add tax-exempt interest if you have it. Then look at where you are before adding another withdrawal. Because the withdrawal itself may not be the only cost. It may pull more Social Security into the taxable calculation. Third, check your Form 1099-R carefully. If you made a QCD, make sure the return did not treat that amount like a normal taxable withdrawal. A correct move with incorrect reporting can still cost you money. Fourth, if you are not yet taking required minimum distributions, look at the years you still have. Those years may be the last cleaner window for QCD planning, Roth conversion planning, and income control before the IRS starts forcing money out. And finally, do not treat 70 and a half like an irrelevant age. That is the mistake. This age may not send you a notice, may not create a deadline that feels urgent, but it can open rules that affect your taxes for years. Drop a comment and tell me which one surprised you most. Just type the number 1 through 7. That tells me which topic needs a deeper breakdown next. And before you leave, watch the next video on screen. Because if IRA withdrawals can trigger one tax chain, your home and long-term care planning can trigger another one most retirees never see coming.